So today I want to talk about the payroll reports, productivity changes, and Chair Powell's challenges that he has facing him. So this is a really unusual market we're in, where current conditions are really creating challenges for investors, but also for the policymakers, because economy is not working the way it historically does when you're in this period where we had a massive move up in rates in a very short period of time, which has brought inflation down, but unemployment hasn't responded the way it has done historically, and that's actually creating some greater strains. At the same time, you have markets around the world hitting new highs, but most of the country, several of the major economies also moving towards recession-like characteristics. So you have this really, it's a real conundrum for policymakers, but also for investors. And then you add to that, with all the elections going on, and particularly the US election, very binary policy outcome of a Biden win versus a Trump win, if in fact those are the two candidates, then you actually can see the challenges that we're faced with. So you had a really interesting series of numbers out lately. We'll start with the jobs report, which had something for everyone, bulls and bears, because if you're a bear and you wanted to say that the Fed's not going to be able to cut rates as much because of the pressures, and you see a $275,000 jobs number, you get a little concerned. The bulls then turned around and said, yeah, but the January and December numbers were revised down considerably. So where are we really in the jobs number? So you're seeing a lot of squishiness in the numbers, which is why the central bankers have been so hesitant to move very quickly. But there is strong, reasonably strong job growth and job creation going on. But there are some other challenges brewing in the job market, which we'll touch on in a minute. You have average hourly earnings dropping off slightly month over month. So again, part of the slowing of the inflationary pressures, but there is more to come in this area in terms of wages coming through, whether it's the Boeing Machinists Union, whether it's the European Auto Union workers. Some of the flight attendants union is also up for contract negotiations. And a lot of workers seeing these big increases are also demanding higher increases coming through for themselves. So I don't think the wage pressures are over yet. I think we'll see more to come in that area. The unemployment rate creeped up a little bit. And if you go back over the past, basically 5 or 6 months, you've seen it move up about 0.5%. And it's getting close to a rule that triggers that historically, when you have that big a move in the 3-month average of 0.5 point in a short period, the SOM rule would say that you're moving towards recession. I would also just point out that in the past, it's taken almost 2 years before the employment rate to move up enough after the Fed increases rates to create a recession. So we're really right around that period now. So we're not out of the woods yet. And I think that's one of the things that the policymakers are concerned about. So the numbers are really pretty staggering. I just went through these, but when you think of the January revision was, 100,000 jobs. The December one was about 40,000 jobs. Those are big changes where the government would be in healthcare and government. So I just want to get to the other side of the coin, which is what's going on with job cuts right now. And you've seen a pickup in that. And this chart goes back to 2014, but you can see with the pandemic, you had a spike up in job cuts on the quarterly conference calls. It then came down quickly, and then you saw a spike up again last year when we started raising rates, and then it came down again, and now you're starting to see it move up again. So I think this is an area that's creating some concern, and I'll show you why. This is the Challenger job report for February, and they were talking about 83,000 job cuts, which is the highest single monthly total for cut announcements since 2009. And where are they coming from? It's the tech sector, starting with that. This chart is of tech. Financial services have been cutting a lot of jobs. In both cases, they were doing some hoarding of labor during the pandemic because they could, and they took advantage of that. Now they're starting to see the layoffs coming through, and other industries are following. The good news with the tech cuts is that it's allowing industries to get the talent that was being hoarded by the tech industry. And now it's getting into all the other industries, which will allow them to increase their productivity, which we'll touch on in a minute. But why were they citing the job layoffs? And I thought this was really interesting because it was a pretty full survey from Challenger, and that the responses are quite many. What's interesting is obviously the restructurings and the closings and all that, and cost cutting and general market economic conditions. I think this is all a sign of that there's really two different markets in the stock market. There's the guys who are in a bad financial position and not growing, and the guys with good financials and are growing. And I think that bifurcation is real. What was interesting in this survey, though, was that when they asked about AI, it was only cited by 383 respondents that was the reason for the cuts. I think companies are a little concerned about citing AI for job cuts as opposed to doing it in the updating or incorporating new technologies. I think they don't want to be viewed as with the ESG kind of movement to be heartless companies cutting people off because of the introduction of AI. But I think it's real and it's coming. It's a variety of factors, let's put it that way. So switching gears to productivity, it has been on the rise in the US, but what was interesting, not so much in the UK and the Eurozone. And if you go back to the financial crisis, the US productivity has grown at almost twice the rate of those other regions. And I think there's a number of reasons why that this is the case. I think it starts with the response to the financial crisis and how the US responded and how Europe and the UK responded. A lot of that has to go to how we dealt with the financial system, both on the banking side and also from central bank policy. But then as you move closer to 2020, it then was the response to COVID and the pandemic, and how did we respond to that? And then you throw in the war in Ukraine, and you can see where the US versus Europe and the UK would be in very different spots. And then in the UK, you also add Brexit in, and you can see some of the differences there. But I think the drivers are real.
Stephen, just on that, is what Nancy Lieber was talking about, the investment in tech CapEx, would that be a factor in US versus Europe?
Yeah, I think I was going to get to that, Mark. I think the policies that we put through are really part of the big difference, but not all of it. I think it starts with the US system is rooted in very strong corporate leadership. And even though the corporate leadership has changed by industry over time, the US still has the significant leadership that I think we have 9 of the top 10 largest market cap companies in the world today, the other one being Saudi Aramco. But I think it goes back to the other strengths of the US, our reserve currency status, the depth and quality of our capital market system, the fact that we're a leading energy producer right now. I think we hit a record for production last month, where I think we were up to almost 13 million barrels of oil a day in production there. Our population growth has been reasonable. If we got our immigration policy right, it would be phenomenal. And then our consumer base is helping. But I think the big difference over the last couple of years is our industrial policy is driving us, and the strength of our global corporate champions is meaningful. But I think the industrial and military policies we put in place are really major and are underappreciated even still in the market. So I think those are the real positives. I think the energy issue and also the limited fiscal space to respond, and even the challenges for Europe of getting the collective act together, given the institutional structure of a monetary union without a fiscal union, I think is part of the problem. But everyone needs greater public and private investments. I think the challenge in Europe is a lot of their private investment is coming to the US, and that's sucking capital and jobs away from there and taking some of the energy away. So I think that all gets to the productivity challenge there. But in the US, we had a period of decline with COVID where you saw productivity drop considerably. And everyone thought how productive we were during the pandemic. I think it's remarkable the adjustments that people made, but actually in numbers, we were less productive as a system. And now you're starting to see productivity move. And that's before the real kicker from AI comes in and improving productivity. So I think we're on an upswing there that it's going to be very positive, and it's going to help one offset the inflationary issues, because we like to say productivity is the antidote to inflation, and that's something that is really important for people to keep in mind as we move ahead over the next couple of years. This is just another chart showing it's got all the right metrics. So you see output going up, productivity going up, but hours worked flattening, and that gives you the productivity improvements that you need. That helps move the system forward in a much more productive way. So I want to go to the central bankers now, and I'm going to wrap up quickly here. But this is what Lagarde was saying last week. Really good progress, not really where we need to be in terms of confidence, but they think they're going to be more confident in June, by June. That's a pretty strong signal of where they see things going. Powell said something similar within a day of Lagarde saying that, where he thinks we're not far from having the confidence we need to start to reducing rates and dial back the level of restriction. So that's a real positive. It says we're getting closer to it. The market has started to adjust back to where the central banks are. Remember, after the December meeting, the market was looking for 7 cuts this year. I think they're now in line with the Fed at 3. I think you could see anywhere between 2 and 4 cuts this year, depending on where we go, as it's setting up right now. But I think the idea that we've talked about for some time of the higher for longer is really what we're seeing right now, and that rates will stay at a higher level than the market is hoping for some time. The New York Fed was looking at the expectations out 5 years, or 1 year and 5 years, and they just produce this report regularly. And the consumer expectations for inflation 1 year out are 3%, but 5 years out are only down to 2.9. So they're not seeing the drop towards 2% that the Fed's hoping for in those expectations, which actually is part of the challenge. The Fed needs to have people confident that they've broken inflation before they aggressively cut rates. So I'd just leave you with that. So our views are very consistent. We're in a slow growth, slowing inflation, soft landing environment or no landing environment right now. That could change with a couple factors. This supports the case that the Fed and the ECB have not been behind the curve, and they're really in line, and that the market was getting ahead of themselves. And I think the market got ahead of themselves because they were concerned that they weren't going to get the multiple expansion that they needed to get the market to move up, when earnings were not going to be evenly distributed, and they might not get what they needed. But I think the market's come back to the Fed and the ECB, and the Fed and the ECB have been pretty clear on where they're going next. I think they're reaching action level now. It won't be quick. And I also just came across some research that there's a lot of talk about what the Fed does that will and won't do during an election year, but I think they've raised rates every year in an election year for the last something like 8 elections. So I don't think that's going to stop them in any way. I do think the market is really coming around to the view of the Fed. But I think that'll still lead to positive markets for this year. But I think we're about to have a lot of bounce coming. I think it'll come from a couple of sources. These numbers are conflicting that we're seeing with the employment and the CPI numbers. And I think that's not aligned with things moving down as quickly as they'd like. We favor the US over the rest of the world. We think this is definitely an actively managed environment. We still favor growth over value and strong balance sheets over weak cash flows. I want to leave you with a cautionary note from Raphael Bostic in the Atlanta Fed, where he's talking about pent-up exuberance. And they do the GDP now figures, and they're very attuned to what's going on. And he asked business leaders what they thought, how they would act in a rate cut, and they thought they were going to move very quickly. And his worry is that that's going to lead to a new wave of demand that could reverse all the progress we've had to getting inflation in line. And he thinks the threat that he's worried about is pent-up exuberance leading to the market running away like it has in the past, which is great if you're on the ride up, but when that ride ends, it can be an awful drop down. And I think this is just something to keep in mind. For all the negativity out there, we could see the market really run if they get too aggressive on cuts. And I don't think the central banks want to see the whipsaw economy like we've had. They'd like to get us on a more steady state. So I'll leave it there, Mark, and open up for discussion.
Thanks, Stephen. Questions, comments? Radek?
Yeah, thanks, Stephen, for this great overview. My question is regarding the employment cuts. You've mentioned that the companies and the CEOs hide the real reason, some of the real reason about connected with this job cuts. And I was wondering, would you be able to give a ballpark or estimate what would be connected with including new technology as AI? What would be the percentage of the job cuts that was that derived from this?
I would suggest, I don't have the numbers, but I would suggest it's too soon for a lot of the cuts to be AI related, because I think that the companies aren't there yet in implementing AI in a meaningful enough way to have massive job cuts from it. I do think they are, I think in a lot of cases, it's in the tech and financial services, they just overhired because they were worried about a talent war. I think now that's starting to change, and I think they're getting more rational in what they're doing, and that's going to feed through the rest of the industries. So I think it's really not as much AI related now as it is the financial realities that they're all coming to of where they are in their business, and are they growing, or do they have to start cutting costs to be viable going forward? Because I think we're in a really bifurcated environment between the haves and have-nots corporate-wise.
Okay, thanks a lot. I would just like to drop something from our market. So there was a huge interview with a CEO of a big Polish tech company, and he said that last year he had 3 CVs for a developer. Right now, when they put a developer job offer, they got around 100. So I would say that it is really noticeable in our tech market that the layoffs have been made. Thanks a lot.
I actually am chair of a travel tech company that does AI, and we have a developer positioning. I think we got 600 applications for the job. So there you go. The talent's out there.
Adam,
finally, I would say finally for us.
Adam?
Yes, thank you, Stephen. I got 2 questions and a comment. I'll start with the comment. Mark, you look like you're getting ready to do a fireside chat. So I'm looking for a smoking jacket and oh, yes. There we go.
There's the fireside.
So my questions, Stephen, are I'll start with the first one. You mentioned 2 to 4 rate cuts in this year. Is that your expectation, or is that the market expectation?
The Fed's at 3. The market has been bouncing around. They're coming down now. I think there's the 2 is my view that it could be in that range, because I think it's the numbers are swinging pretty dramatically in a short period of time. I don't think we have enough data points for the Fed to act, but I do think they're going to act this year. The degree will be dependent on how the economy operates. There are people now saying that they could have none, and there are others that saying some of the numbers could give them a 1 increase before they start cutting as well. I think it'd be very hard for the Fed to do an increase. I think they would more likely go longer before they did any cuts. But an increase would be a market event.
Yeah,
so I think that's the probability. But I think you could see things move faster in either direction, just the way the numbers are flowing. And I think there are some other factors that could drive that. One is the outcome of the war in Ukraine, which the slowness of the West to respond and how aggressive the buildup seems to be from Russia, I think that could have a big implication. That could be this year.
Sure. And my last question is Mohammed Al-Iran said today something to the effect of the deflation of goods is not going to continue forever, and that there needs to be a deflation of services. What exactly was he talking about? Was he referring to the wage increases that are
the way to look at it is when the pandemic hit, goods spiked, and then they came down pretty sharply. Services have moved up, but they haven't come down as much. And he needs to get better balance between the two, is what he's saying.
And those
services I said versus what he said, go with him.
Okay.
Just to be clear.
Michael Hammer?
Yeah. So I'm going to go back to my usual topic, energy. And Stephen, you mentioned energy. Oil has held up. It's been in the high 70s and bouncing around a little bit. Natural gas is at incredible lows. Today it's like around $1.72. And I look at that and I go, ouch. But I also look at what's going on here in the Utica, and activity is really up, right? The rig count is down slightly, but the rigs are more efficient in terms of how fast they can drill. A lot of the supply companies, Halliburton and whatnot, you see their vehicles all over. And I'm scratching my head because, recently the mantra has been that investors want to see returns, and clearly natural gas is not providing the returns. So the only thing I come up with is folks are betting that permitting delays from the administration are not going to be that long. Do you have any thoughts on why I'm seeing what I'm seeing?
I don't. Actually, it's fascinating. Other than just natural gas is such a local market versus oil, which is really more global, just because of the way you can move it around. But I don't really have a good sense. Maybe Andrew Fish, do you have a point of view on natural gas since you're an energy guy?
Well, having been in that market, it's partly the technology and productivity to your earlier is we just keep getting better and better. And we can produce gas cheaper. And that's why they're producing.
Well, it's more complex than that. So if you look at the Permian, for example, natural gas is a byproduct.
Yeah.
Oil is the play. And
but in the Utica Marcellus, you don't see that as much.
Right. So the Marcellus and the Utica, it's more of a gas play, and oil is the byproduct. But it's really the Permian production, because before they were just flaring it off. Now it's actually getting to market. So there's a bit of complexity there.
Yeah, I think part of that has to do with the Northeast use of it versus the Southwest use as well.
Plus,
when you're talking about the difference in the markets.
Plus, it's been a warm winter, so storage is full. We might even see, like we saw a few years back, where spot prices went to -35.
Mm-hmm. Yeah, there's a lot of disruptions and distortions, but I think you're right. I think the winter is a big factor in that as well.
Other questions, comments?
Yeah, Mark, can I make a quick comment on that energy? I did a piece on the Russian pipeline gas last week. And there's a big amount of LNG being shipped to Europe from the United States. The United States is the largest shipper of LNG to Europe right now.
So yeah,
And the Europeans are also looking for storage for the existing inventory of gas that they do have. It's 67% higher than what they were expecting this time of year. And they're looking to lease storage facilities in Ukraine for the gas.
so right now, exports of U.S. natural gas represent about 25% of production. And if you go back historically, it was more like about 7 or 8%.
Yeah. Wanda, question, comment?
Stephen, your comment about buildup in Russia and the impact on potential increase of interest rates. Can you speak into the general business impact outside the politics? I mean, defense will grow, but how we should think about that?
I'm actually getting my mind around the fact that the West is really not stepping up as much as they should and what it means. So I don't really have a good answer on it yet. It's something we're actually starting to think about, the implications of what if Russia really does run over Ukraine in the coming period, and what does that mean? At the same time, we're going through an election in the U.S. It's a concern that I think people thought it would be more contained and not spread, but I don't think we've looked at the downside enough of what happens if Russia does run them over. So I think that's something we have to think through. I haven't really gotten through it yet to figure out what the implications are.
Are we hearing is there any solution to the logjam in Congress? I was hearing talking about a loan to Ukraine. Is the Republicans their solution?
I don't know. I think the Republicans are going to block what they can do until Trump says not to. And I don't think Ukraine necessarily has the time for that politics to play out. That's what's concerning me right now on that one. So,
I'm sure you all read about or heard about the Hungarian Orbán meeting with Trump yesterday and saying that Trump would not give one more penny to Ukraine, and that's how he would end the war. And right now, Trump, let's face it, is running the Republican Party, and nothing gets through right now without his approval. I mean, it's pretty obvious.
And the implications of that go beyond Russia. It goes right to South China Sea and Iran and all the adversaries who say the West folded. And I think that's really the issue that's out there right now.